I'm Athanasios Psarofagis. I'm an ETF analyst covering EMEA for Bloomberg Intelligence. We actually have a really great panel today. It's called The Shape of the ETF Industry. I'm going to do some brief intros on the panelists, but what I like about this panel is that there's representation from all different sides of the industry, from the strategy side, from the trading side, from the distribution side. So I think there's going to be some really good, inputs and some good discussions. Some brief intros. Right next to me is Rebecca Chesworth, who is the Senior Strategist of Equities and Sector ETFs at SSGA UK. Next to her is Dijkstra, who's the CEO of Flow Traders. And lastly, we have Thomas Merz, who is the Head of Distribution for Europe ex-UK for Vanguard. So welcome, everyone. I don't want to spend a whole lot of time on MiFID, because it's probably a term that everyone's sort of tired of hearing, but Rebecca, let's start with you. I know it's been a short time since MiFID has been implemented. How is it you've seen it pre and post MiFID? Any perceptions changed or any areas that you think have been underwhelming to you post MiFID?
It's certainly not the game changer that we thought it was, because we spent many, many years thinking, worrying about it. But I think it's work in progress. I think, from where I sit, so within the strategy world, I think, it's done two things. So one thing we do at Spider is we watch very carefully how much is being traded on order book, off order book. And I certainly know for the people that sit behind me in the capital markets team, that's one known unknown that we've uncovered. So we know a bit more about our trading. We still think there's a much more to go there in terms of consolidation. And then, in terms of the work that a strategy team would do, I'd actually say it was a positive, because what I hear from investors is their research, in some sense, has been cut off. Now, we can't write research, we can't put out actual recommendations, but we do write about the markets, and we give thoughts, and we give ideas, and we try to educate the client, and that kind of thing has become more popular and more valuable to the clients receiving that type of work.
Dennis, you had mentioned about trading. What has seen some of the biggest changes that you've seen pre and post MiFID from the trading side?
Yeah, I think somebody spoke about disruption as well, right? Also there, I think also the whole institutional trading, I think before MiFID 2 with the RFQ platforms already being there and kind of transitioning into regulated MTFs. I think that really helped, where we brought kind of more fixed income related infrastructure and kind of electronified the whole institutional trading, right? So also there, I think ETFs and the whole ecosystem have disrupted the market, and both technology, because it's predominantly technology driven, but also regulation really helped. And also there, I can think if you look further down into the future, I think regulation and technology should help kind of grow the markets further. If you look at kind of other places or other products, I think ETFs are kind of already kind of on the axis we kind of measure it kind of top right, where kind of the equities are, but fixed income, FX, but also other products are hopefully pushed more to global, scalable technology and regulatory-driven, transparent, and kind of scalable, cheap markets.
Have you seen any pickup specifically in any areas, like in trading, like fixed income you were just mentioned?
Yeah, I think fixed income, equities are kind of more transparent, or people are more familiar with. I think fixed income are kind of still very much underrepresented. People sometimes worry about liquidity, which I think it's not a big issue. I think also if you look at kind of the global markets, where especially the US is kind of pretty ahead of us here in Europe, but I expect it to pick up, and also kind of getting people familiar with kind of the indexing in the fixed income space, but also the trading. I think that will kind of that will continue
Yeah, Thomas, how about you? Is there maybe even any areas that you think have been a little bit underwhelming post MiFID, or any areas that maybe surprised you to the upside?
Yeah, I want to spin probably my answer a bit away from a pure technical trading aspect and more into the use of ETF and the penetration of that, let's say, innovation in some way further into other segments of the market. And I think, Paul was talking about disruption and, cheaper, faster, better. I think that post-MiFID, it's not yet, arrived. It hasn't arrived really in a broader market, What I see, and it's quite a development, I guess, over the last couple of years, is ETFs being a very institutional driven instrument. About this trading aspect was very important. Nowadays it's becoming much more an instrument used for all sorts of kind of applications in portfolio. That's pretty new, right? On one end is even big central banks never used ETF before. went, on the bond side, actually just single stock, did themselves or mandated it out to third parties. Now starting using even fixed income ETFs, which is fairly new. That's the extreme institutional end of the spectrum. And then the other one is really becoming core building block, right? Literally constructing portfolio with ETFs had never been before in client segments which are more intermediate retail and intermediate wholesale portfolios. I think MiFID, and that was my hope, right, will bring much more transparency and kind of clarity, what you pay for, how much does it cost if you select this fund, if you ask this advisor to give you advice, and so forth, which I think is a bit early to really see the effect of it. But I think that's my big hope for the future of ETFs, that this transparency, this educational kind of clarity. What are ETFs? Why they're good? When do I use passive? When do I construct also active parts of your portfolios? That will come over time, and I guess ETFs going to benefit massively from that process.
Yeah, you mentioned education. I know we always sort of say education. How much do you think more is needed in Europe? Like, do you think that it's sort of maybe compared to the U.S.? Like, do you think there's still more needed?
I mean,
I know
which is starting, I guess, right?
Yeah.
When you're in the industry, you think, I can't hear it anymore, right? Like secondary, primary market, probably you can't look at that chart anymore. But it's just that the new risk report came out. The first section is, how does ETF work? I couldn't believe. But yeah, that's the point. I think there's a long way to go. And interestingly, and I think that's an interesting, kind of differentiation is, in the US, my understanding is there was no regulation put in place to really, break up that captiveness of the markets. But it was a market dynamic and movement, which then kind of was more fee-based. It's not 100%, but going more fee-based. ETFs were probably one of the tools to use, right? So it was not the regulator who pushed it down, but it was a lot of education which kind of made that movement going. And I think that's what I see some parallels here as well. Yes, we had RDR and we have ban on retros here in this market. In the rest of the European markets, there haven't been similar regulations. And I think probably the combination will do it. A lot of education, transparency, explaining to people what they do, how they can use it. But also the regulation will probably, a next MiFID or whatever it will come, will drive the process even further.
And I would see that always the opportunity to educate is your engagement, is your extra opportunity to engage with the investor, and just making it much more relevant to the investor about how they can and will use ETFs. Yeah,
I think you brought up an interesting point, because I was covering the U.S. before this, and you're right, I think sort of advisors figured out the market on their own in the U.S., and here the regulators are pushing people towards that, so it's definitely a little bit different. I'm going to start the first question, but we're doing another poll, so we'll ask you, so as we're pulling it up, I'm sort of going to turn to you and sort of, we talked about MiFID in the past, but let's focus on the future. So I'll pose the questions. What will drive the most asset growth in ETFs in the next 5 years? And then they will come up, but it's going to be cost, regulation, or innovative strategies, and the votes will come in. But I guess, Rebecca, I'll pose the same question for you. Sort of, where do you see not only like the growth from these three choices here too, but is there maybe anything else like robo-advice or whatnot? Do you sort of see the growth of adoption?
I think my answer would come into that first category, the innovative strategies. I think the proliferation of strategies is a very good thing, because I think it gives you more and more uses, and you're getting closer to the client need, you're getting closer towards customization, what every investor needs, and I think that is the positive driver. But also that's possibly, if you would say to me that's the positive, it's also possibly the negative as well, because with this proliferation of new strategies, you've got hundreds and hundreds of funds, and therefore us as the product providers are therefore more and more in competition, and there are going to be some funds that just don't quite make it in terms of scale.
Yeah, we see that too. We also, as the number of launches pick up, sort of the number of closures sometimes too. Looks like cost is sort of leading out, and I guess, Dennis, I'll go to you because there's sort of a few things with cost, right? We're always just looking at the headline expense ratio, but there's other things that go into it too, right? Especially on the trading side, bid-ask spreads and whatnot. Do you think that that's maybe Do you agree with some of the answers here from the
I
audience?
think also there kind of the European market the market structure is kind of different than the US one, where the US is kind of a consolidated big exchange where everything gets traded or it's kind of linked. Europe, it's still very fragmented, right? So kind of German exposure, DAX is kind of predominantly traded in Germany, that doesn't help. So the scale also still kind of there MiFID II did help, kind of the unbundling, so also focusing on the cost of execution. But I think a big part of the growth is also a big part of the money is really sticky. So I think a big part of the growth of the ETF industry will come at somebody's expense, which is probably or highly likely the mutual funds. And also there, right, it's kind of difficult for kind of that whole market to transition and kind of get to terms with the new reality. And probably the kind of the ETF market is a bit ahead of kind of the changes they're going through. So I think it's not per se focused on costs. It's more about transparency. People really understanding what the impact of kind of an additional 20 basis points annually will do to kind of 30-year return. So if it compounds, it's big. And I think we here in Europe see a lot of real institutional kind of investors kind of looking at seriously at ETFs like central banks, big pension funds. So it's kind of, you would expect kind of the retail to kind of be adopting it, but it's kind of the reverse. And also if you talk to the US industry people, also there kind of you see kind of the highly institutional kind of firms really looking at it seriously and using it, where I think had the biggest growth and difference between kind of the regions is especially the retail part. But that's kind of I think probably regulation will need to drive the transition there.
Yeah, and you just mentioned regulation. Thomas, I was going to you because we've done all these events now, and regulation always seems to be lower than I expected.
And I always give the same answer.
Yeah,
right?
but I was actually surprised all the different cities, how low.
I agree with Dennis about cost. I totally disagree with innovative strategies, and I lean towards regulation and cost. And I think we've started talking to Flow Trader many years back, and I think one of the big advantage companies like Flow Traders brought to this ETF market is it was become almost transparent what you actually pay if you sell and buy as well. So the total cost of ownership, which in mutual fund is sometimes very difficult to estimate. I think here, that's one of the big benefits. So focus on costs, yes, but focus on total cost of ownership, I would argue, like you did. But I would probably be tilted towards regulation will play a massive role, I guess, in the growth because, I understand, the European market, talking to a variety of clients across Europe, it's always the same thing. They're very much intermediated. They're very much in a captive structure where, something like ETFs, they have a hard start because obviously, being in a world of still paying retros and giving something back or receiving something by having product A, B, C on the shelf, ETFs never went there, right? And I think having a structure in Europe where still this is the, kind of the way to go, I think regulation will move in and will have, combined with other things, but will have probably a very strong spin because I don't think so we'll have the same development as in the US where commission-based, fee-based is about, I guess, about 60-70% of the market. So it's not 100. It's not going to, like, the old model is not gone away, but it has been replaced by this new model. And I think in Europe, it's going to need regulation to do that, I guess.
Yeah, I agree. Let's talk about sort of what I think is the most interesting is I think clients always like to hear like how other people are using ETFs, how other investors. Let's talk a little bit about sort of use cases and whether it can be pre-MiFID, post-MiFID, or just in general. Sort of, Rebecca, we'll go with you. What are some of the more common ways you've seen?
This is something that I would spend a lot of time talking to investors about how they're using them and then suggesting other uses. And then going back to my previous point, I think this proliferation of products has been a good thing because products are now, there is now almost a product for every part of your asset allocation process. So we're not quite there, but there's almost everything that you're going to need. One thing that I like, because I come from an active background, and therefore I've been very interesting to see what can you capture in this beta world. And what ETFs are allowing you to do is to divide up your beta or capture more of the beta. So if you think about the extension in thematic or sector ETFs, in country ETFs, in smart beta factors, in risk factors. Each one of those allows you to play that dispersion of returns across the beta range. And I think so with each almost innovation, you're allowing yourself to capture a bigger, you're expanding the beta that you can capture, and you're worrying less about the alpha that you might be missing. I think that's where the conversation's going. And if I come back to something that I talk daily to clients about, and that's sector ETFs, and I'm sorry, it's something I'm very passionate about because I really think they provide a great opportunity. But within one product, you can see it used in many different ways within portfolios. If you take a sector, we take financials, you can see that a sector used within sector rotation as part of a quants model. You could see a sector used tactically to implement your market views, your macroeconomic factors, how am I going to play interest rates. And you can also see something like sector ETFs used for risk management. So the very simple portfolio completion, where my client's underweight, how do I very quickly cover that underweight position? So I think what we're seeing in the industry is a broader use, a more expansive use within portfolio strategies.
Then we'll go to you, and sort of one thing that I hear a lot is sort of like using these as access vehicles, right, or as like liquidity sleeves. Do you see a lot of that when you're talking to clients daily?
Yeah, definitely, and also there globally, right? So I think also a big part of the transition in Europe is kind of having the investment advisors getting comfortable with ETFs and kind of how liquid and easy it is to execute. If you also look at the comparison between the US and Europe, we see kind of the big kind of firms like TD, but also kind of UBS, or Merrill's, which have a huge kind of wealth managers background. How the big part of the flow comes from those firms, where they kind of the investment advisors are very comfortable with using ETFs. They have a lot of kind of different products to choose from, so they can really add value at a very minimal cost, both kind of from a trading, but also from a kind of holding perspective. So there is again also the kind of the really institutional firms are really using it to kind of make sure that they track as much beta as they can, and they're very successful at it.
Thomas, how about you? Sort of common use cases, or is there maybe anything that a client hasn't seen that you sort of bring to their attention sometimes, and they said, "Hey, you can use it like this, actually."
I think something which become very evident is the use of fixed income ETFs. If you talk about the asset classes, which is fairly new. I mean, remember 10 years back there was like hardly any fixed income ETF, and if there were, they were small, right? And they have really stepped out into the light a couple of last years. In particular, I think, using that as an example, I think fixed income ETFs showcase in a very good way the real benefit of ETFs, right? Getting access to a basket which has 17,600 bonds with 100 euros, how do you do this, right? You do it through ETFs, and you do it through companies like flow traders, for example, who can trade that instrument very tightly, right? I mean, think of it, the weighted basket spread of that global ag, right? You can have it in an ETF format probably between 20 and 35 basis points. Do that on a single bond basis. That's going to be probably more expensive, I think. And the more they've been used and the bigger they get and the more they've been traded amongst different investors, that inside spread will go down to levels which probably is impossible to do it when you do it all the time in the primary market. I think that's a perfect showcase where that's the benefit of ETFs, right? The instrument, because it's secondary market traded, gives access to asset classes, to exposures you could never think of with 100 euros or 1,000 euros, right? I think that's one aspect. And I just want to take up one point from that earlier discussion about having ETFs out there for every kind of taste, and you can slice and dice the beta. Partially I agree, and partially I ask myself, where is the marginal contribution to the beta actually? How much can you expand? I mean, and we at Vanguard, we think about what is really needed from a well-diversified, balanced portfolio perspective. Do you need these thousands of products, which in some areas we fear that they kind of disguise idiosyncratic risk rather than beta. And that's where we're a bit concerned about. Yes, it's nice to have all sorts of varieties and offer everything to clients, but we think there is a limit. And sometimes you probably confuse a lot of clients. Not the big ones, not the sophisticated ones. They don't know what they do. But ETFs are traded on exchange. We can't forget this, right? And every man and woman on the street can see them and can buy them on exchange. And that's where advice and perspective comes in, right? And I think that's where, by the way, the whole active thinking in this market doesn't have to be scared at all. They will be needed to give perspective on advice, how to construct a portfolio, and how to use these instruments in the portfolio context. Yes, it's a passive instrument, but passive thinking is not on. It's active thinking. If it's really thinking, how do I construct in my asset liability spectrum, how do you do that? That's not so easy. I think that's where the European market will go to, and will all those advisors will be heavily needed. But yes, they have to step up, in my view. They have to really become behavioral coach, portfolio construction coach, rather than single pick PMs, right?
Yeah, actually, you bring up an interesting point. Now, I'm going to go to you because you were saying that your background is from active, right? You sort of moved over to State Street. When you're talking to clients, either everyone's maybe not fully passive, right? They're coming from a fully active portfolio. How does that journey sort of go? Like, how do you start talking to clients about if they're interested in passive, how they transition over, how they maybe align alongside active?
Essentially, you're using the same skill set. So you are looking at you're using your top-down, bottom-up skill set to look at the market, to position your views in the marketplace. So essentially, you are saying, replace those, and many clients and investors have those stock-picking skills, but replace those skills with your ETF being your stock, if you like, and you're looking at you're educating, or you're talking the clients through their market view, and then how they could implement it. What sensitivities within that portfolio, what themes could they be playing with ETFs? And I think that really is a key part of the discussion, because almost we should ban the word ETFs are a passive investment, because people are getting that wrong. And the more you bring in that active language and say you've got a choice, and you've got a choice from this range or this way of doing it, but let ETFs be the way you implement your strategy, I think that's such a positive step forward.
Just from your experience, what do you think comes up more when they're looking at active? Is it cost, or is it maybe just dismal performance of active? Is it a little bit of both?
I think, we get asked, in this industry, we get asked about cost a lot, but personally, from a strategy point of view, and I think about what my team do, we get asked a lot about what's inside the ETF, how are you replicating the index, what's special about that index, and really what's your performance like, rather than just another basis point off of TER.
Yeah, so I guess due diligence, and Tom said something that we talked about before, so the importance of due diligence on these products.
And I think, just to add, yes, on the product, but more so, and starting off, exposure. Right? You have to do the due diligence on the exposure. So what's your economic exposure you're trying to solve the equation with, right? And to the point of proliferation, that gets very complicated. Look at fixed income, corporate exposures. There are 7 exposures. They all more or less have the same name, global corp or US corp or whatever. They are 7 totally different exposures. The cutoff, credit risk bucketing is different. What's in the basket, is the lot size different? Like that. That's where actually, ETF is not the wrapper, is actually the discussion. It's the exposure discussion. That's where it starts. And yes, we discussed that probably over the last 10 years, in and out, about the structure. Do you go physically, sample? What's the sampling, right? How much degree of freedom has the portfolio manager? And then it goes to trading, right? And I think that's where, thinking in the future, it will happen even more. So directed baskets, right? I'm a PM. I have a certain subset of that 17,600. Can I deal with a liquidity provider who brings me 117,510 and the 760 stock? Bond, is that perfectly fine for do I direct it over a third party? I think that's where innovation really drove, in particular in fixed income, but it's the trading aspect is so important, right? Really drove the benefit and added value of an ETF covering these exposures. So I think there are so many facets which you have to kind of drill down in your diligence that it's actually almost become a specialist job again, right?
Yeah, it's just really, Dennis, I'll go to you sort of on the education stuff. Because let's say they do their job, they sell the client on the ETF, they come to you now, and they have like a bad experience trading, right? And that sort of might ruin it for them. Sort of how much of your time is spent on like sort of educating clients, just even on the education part?
Yeah, a lot. And it's almost always kind of a combined effort. Yeah. So we kind of go on the road together with issuers, but also the MTFs or the RFQ platforms, especially in US and Asia. So that's where I think Europe has led. I think probably almost all of the institutional money kind of uses MTFs and RFQ or MTF platforms already. So that's more of a kind of American, interestingly, but also Asian effort. But it's also always kind of in competition. So I'm not the only liquidity provider, and also don't want to be. So it's always in competition, which is good for the industry and good for the investor. And I said, fixed income is kind of a bit more tailor-made. It's not kind of trading it and kind of the do create redeems. It's less. It's more active and also more of a dialogue. So we're kind of also helping kind of the issuers in kind of the composition of the underlying portfolios and also their kind of the liquidity. So having access to kind of the whole liquidity market really, really helps. So that's where also investors benefit. And a big part of it is giving back in kind of having a small spread. Yeah. But I think there again, there are new names for a lot of people in the whole ETP ecosystem. But it is a joint effort, and it always has been. And it really, really helps. Also kind of the independency.
Yeah, I guess we had more questions, but we're actually down on time. But I wanted to thank my panelists. I thought this was a really great discussion. Thank you for joining. I'm going to stay on stage, but join me in thanking my panel.